But I'm delighted to say that we have David Witte with us, who is the Senior Vice President and Division Head of Energy and Chemicals at IHS Markit, and he's going to be talking to us about the change in the global chemical market dynamics and the landscape for the GCC. IHS Markit is a leading global provider of information, insight, and consulting services to the global energy and related industries. David Witte's career spans more than 30 years in the energy value chain. Prior to its acquisition by IHS, David was Executive Vice President Business Advisory Services at Chemical Market Associates Incorporated, which was a leading provider of chemical information, and also a member of the CMAI's Board of Directors. So without further ado, I'd like to welcome David to the stage, please, to give us his perspective on the changing dynamics of the GCC chemicals industry. Thank you.
Thank you. Thank you, Diana. Good morning. Thank you very much to GPCA and to all of the honorable folks that are here. Happy to give our perspectives on where we're seeing the GCC move, the GCC chemical industry, and specifically how the GCC is going to be a part of the overall transformation, and indeed needs to transform itself in order to be able to go that direction. So as we heard yesterday from His Excellency Khaled Al-Faleh, the theme of transformation of the GCC chemical industry is certainly a call to action, a challenge of sorts to the companies gathered here today to rise to meet the objectives that he laid out. And were it just the industry driving the change, it would be quite a difficult challenge and one likely to take an extended period of time. However, what I heard is that it isn't just the chemical companies who are going to rise to the call and affect the change, but also rather the relationships with governments and key institutions of the GCC as well. So the reason I say that there's a broader call to action here, it's really one that we think is existential and recognizes that the technological, demographic, and societal changes that are global and threatening the primary lifeblood of the GCC economy, hydrocarbons, and it's that existential threat, I think, that's being addressed. And to be clear, we at IHS Markit do not believe that the end of the oil age is imminent. It is likely a long way off, but we do see a demand inflection point not too far off, the timing of which is as uncertain as is the pace of the technological advances and the government policies that are driving with it. And with that risk, of course, is also a risk to those economies that are dependent on oil. So we see the call for the transformation of the chemical industry aligned with the broader need for re-enabling the GCC economy. And this recognition is already being empowered and visible by the changes in the institutions, such as the broader ownership of national oil companies or the retooling of the broader economic regulatory framework, or simply in Minister Al-Faleh's call to action. And because of the broader participation, the chemical industry will have partners who will align with it, and this alignment means the likelihood of success for transformation is much greater and can proceed at a much faster pace than on its own. So I'm happy to be here with you today, and I thank the GPCA for the opportunity to share some of our thoughts as to the chemical industry's role in this broader transformation and how it may be enabled. So I'm going to focus on several different areas. First, challenges facing the GCC economy. I think this is probably just to make the case for change. I think it's probably well known what those are, but just good to revisit those. Why we see chemicals as a solution to those challenges, but within the industry here itself, we also see challenges and a need for transformation. And so we'll finish up with a framework of how we might adapt and work through that transformation, and from our perspective, a model that might serve to guide through the thinking of how things move. From our perspective, the GCC countries are facing, I'm sorry, this isn't advancing. There we go, let's go back one. The GCC countries are currently facing three main economic challenges. Macro instability due to the economic reliance on oil in the era of plateauing demand in shale. unstable geopolitics, and the need for job creation. And macro instability is mainly linked to lower oil prices, which we all know have dropped about 50% since the peak. And being highly dependent on oil-related sectors, virtually all GCC countries are aiming to diversify their economies. However, we need the support of regulatory and institutional framework that are key prerequisites for this diversification. Another factor impacting macroeconomic stability is the impact of foreign direct investments, which, except for the UAE, are still lower than pre-crisis level. Job creation, obviously also an issue, and both of these factors we see is related to the downturn in oil. GCC countries have a large young population, heavily affected by high unemployment rates, and despite a significant rise in educational attainment across most of the region, there's still a mismatch of skills and employment opportunities that are cited as challenges by the private sector in the Arab states. The reduction in the oil price is having a negative impact on public finances, considering that nearly 80% of government revenues are generated by oil-related sectors. In particular, Middle East countries are experiencing a significant decline in government revenue, public spending, current account balance, and international reserves. However, debt levels are still low compared to worldwide benchmarks and expected to be relatively stable. Considering that the current, and in our view, forecast oil price, which is for us $54 for next year, is still below the fiscal break-even point for oil for all the GCC countries, it's negative, and one reason is that few countries or market participants expect Brent to be this low in 2018. But as this possibility becomes more clear through the year, adjustments may be greater than the current projections. It's becoming harder for OPEC governments, however, given the austerity measures that have been taken to date, and there's, as a result, more resistance to cuts by producer countries or public skeptical as what has been accomplished after more than 3 years of austerity. The GCC growth model has delivered strong economic and social progress over several decades. Governments have increased public sector employment and spending on infrastructure, health, and education. This has helped raise standards of living and support private sector activity, but also increase the reliance on oil. The current growth model has weaknesses, and required economic diversification is paramount to reduce exposure to the volatility and uncertainty in the global oil market, help create private sector jobs, increase productivity, and establish the non-oil economy that's going to be needed in the future. The international experience has been pretty poor on the ability to diversify away from oil, but certainly, in our view, what we've seen from our economics and country risk analysis is that ahead of the decline in any oil revenues is where the policy changes need to happen. And in our forecast, we actually are forecasting for the medium term, despite some pullback in 2018, oil prices and revenue to increase as we get into the 2019-20 and beyond time period. And we believe this is an excellent opportunity to use the additional revenues to fund and enact policies that truly do diversify the GCC economic base. Shale technology, while currently limited primarily to the United States, continues to create uncertainty and places pressure on OPEC to constrain output to balance the global markets. This is contrasted against what we would see as a near supercycle backdrop of global oil demand growth. If you look at the cumulative 5-year rolling average of oil demand growth over the last 5 years, it's as big as it was going up into the 2007 period, and we are still quite bullish given the global economic situation on demand growth in 2018. But we also expect shale volumes to continue to grow substantially up until the mid-2020 timeframe. And while those shale-related oil volumes are growing, other non-OPEC national oil companies like Pemex and Petrobras are aggressively opening their sectors to encourage investment, while other shale-rich countries like Argentina and potentially even Russia are restructuring their energy sector to also unlock substantial shale resource base. Moreover, and a new phenomena, the nature of shale as a short cycle, fast response to prices and its ability to spin up volumes very quickly is a new dynamic. The sensitivity of the U.S. shale system to relatively small price changes is remarkable, At prices in the lower $40 per barrel range, U.S. shale production would probably shrink in 2018. While it is likely to grow close to 500,000 barrels per day entry to exit from a year standpoint at prices north of $50 barrels. And at prices near $60 a barrel where we are today, there is the potential for even more acceleration just because of the financial hedging and how quickly this volume can be brought on. One of the other drivers for more rapid monetization is risk on longer-term demand growth. IHS Markit's forecast is that oil demand will plateau and begin to decline gradually, owing in part to lower demand from light-duty vehicles. IHS Markit is the leading energy, chemical, and auto consultancy globally, and our recent Reinventing the Wheel study gathered from executives in the critical value chain examined the future of mobility. Our base case assumes that transportation fuel demand will plateau, as I mentioned, in the 2030s timeframe, but we recognize additional risk to that model, depending on the pace of policy changes or other technological breakthroughs. The net impact highlights the need for GCC economic diversification to reduce exposure on economies to volatility and uncertainties in the oil market. Secondly, diversification creates jobs in the private sector that are needed to absorb young and growing workforce, working age populations in the region. Given that the GCC countries are high-income countries, the private sector will need to create high-paying, high-productivity jobs in high-value-added sectors to attract nationals. And then finally, increasing productivity and sustainable growth, which would help put the non-oil economy on the path for what it's needed many years down the road when oil revenues start to dwindle. The private sector produces to meet the consumption and investment needs of the domestic market in the GCC generally, but it employs few nationals. Instead, it depends on low-wage foreign labor. Nationals are employed in the public sector traditionally and typically seek an education that prepares them for those jobs. As a consequence, the government wage bill has become large, 10 to 15% of GDP in the case of most GCC countries, and 30 to 50% of all government expenditures. However, with the GCC labor force projected to increase by some 6 million nationals by 2030, it will be difficult for the government to continue to absorb new labor entries unless the employment of nationals in the private sector increases, and unless this happens, unemployment is expected to rise. The chemical industry can and should play an important role in the diversification of the GCC economy. The ability to extend and leverage the current oil and chemical position into value-added intermediates and derivatives has already proven a valid strategy in a number of cases, but we believe more can be done. The ability to integrate into refining raises overall refinery returns and provides a platform to horizontally diversify the basic chemical backbone. And in addition to economic expansion created during construction, the investment provides valuable longer-term sustainable and positive economic expansion through direct employment, but also perhaps more importantly, a leveraged effect in terms of innovation and additional derivative investment. So let's look at some details. It's important to realize that regardless of the oil price, in fact often inversely with oil price, chemical demand will grow with the economy and likewise contribute to overall economic growth. Chemicals are so fundamentally ingrained in the economy across so many sectors with continued and expanding opportunities to substitute for conventional materials that we forecast over the coming decades only a gradual slide towards GDP-type growth rates. And in markets like the Middle East and Africa that are growing rapidly with expanding populations, that implies relatively strong volumetric growth for quite some time. In fact, the growth is expected to be multiples of transportation fuels. There are a number of strategies that energy companies are employing to de-risk the impact of plateauing demand and the decline in transportation fuels. Besides additional forward integration into chemicals, these include shifting to gas and renewables and focusing on fuel markets that are not expected to experience the same decline from electrification and automation. Refining integration as a pull-through of equity crude is another strategy that makes sense, and chemicals play into this strategy by not only buffering the product slate away from fuels, but by improving refinery competitiveness. This graphic shows the net refining margin for the east of Suez capacity for 2022, the markets that Middle East refiners typically produce into. The margins include petrochemicals, up to light olefins, excluding polymer margins and aromatics. And essentially what you can see in the graphic is all of those in the first quartile, every one of those is integrated in with petrochemicals. And the more it's integrated into petrochemicals, the more profitable it is. Moreover, the return on capital employed is less variable and accretive to the overall refinery returns. As shown on, so while the Middle East gas feedstock availability is more limited than in the past, conversions of liquids through refining, as we saw with the Aramco SABIC announcement, is growing, and the integration of chemical with refining improves competitiveness and provides a broader backbone of basic chemicals from which a downstream industry can be expanded. Almost every industry purchases and depends on chemical products. Indeed, the chemical industry is key to a number of major consumer products, including apparel, appliances, furniture, home furnishings, autos, as well as agricultural and construction. Looking downstream, the chemical industry enables activity in a number of ways. Actual production of chemicals, industries manufacturing products that purchase chemicals and use them to make raw materials or intermediate inputs for other industries, industries manufacturing consumer products and other final goods which purchase chemicals directly or buy industrial parts and components based on chemicals, and wholesale and retail service industries based on finished and semi-finished goods. According to the GPCA, the GCC chemical industry drives the creation of 3 other jobs in other sectors of the economy. That's today, I think in 2016, about 150,000 direct jobs, 450,000 indirect. However, as you can see in this example for the United States, the multiplier is closer to 7. And you may ask why. And the reason for that is the nature of the U.S. industry and its wider and broader horizontal and vertical integration and diversification to more value-added sectors. The Middle East tends to be more focused on an export-led model that efficiently monetizes its vast resources, but leads to employment multipliers that are a bit lower. And while these models demonstrate a strong multiplier effect, the chemical industry economic impact is actually much more extensive than even the standard output and job multipliers that we're showing for the U.S. indicate. These methodologies only analyze direct job creation or supplier and indirect job creation as a result of expenditures. However, the true effect is multiples of that shown, multiples of the multiple, when one considers the enabling effect chemicals have on downstream industries. The industry will continue to provide the materials necessary for a healthy and sustainable world and drive the innovations that make tomorrow a reality. In the next 10 years alone, the global population will expand by another 1 billion people, creating an ever-growing demand on the Earth's finite resources. Chemicals enable the world to meet this demand with a safe and plentiful food supply, clean air and water, efficient and affordable energy sources, and life-saving medicines. It's a dynamic, forward-looking, innovative industry and a keystone of any economy. It's also an enabling and transforming business. But within the GCC, we see some headwinds, and I think some of the financial metrics that you'll see here bear that out. Sustained weakness in oil prices have broadened the gap between the US and EU specialty diversified chemical producers and Middle East-based commodity producers over the last 5 years. US company earnings reduced in 2016 as prices slid in some product areas, but the US commodity diversified producers still enjoyed a favorable competitive position, with domestic natural gas prices having fallen in tandem. The competitiveness of EU producers has improved with the oil price movement, flattening the cost curve, leading to a continuous increase in EBITDA since 2014. Many producers have witnessed material cost reductions of more than 50%, improving margins considerably. At the same time, the slide in the oil price, along with higher gas-based domestic pricing, has led to lower EBITDA for Middle East commodity chemical producers. In summary, global industry performance is being driven by the pure-play specialty and diversified chemical companies, putting pressure on the Middle East producers to drive excellence across the entirety of the value chain. Aside from the lower gas to oil spreads, there are other more structural reasons that investors have given relatively lower values of late for Middle East commodity companies. These include reduced availability of advantaged feedstocks, leading to reduced new feedstock allocations and expectation of lower returns, Indeed, the non-GCC investments in North America by companies like SABIC and PIC and APAC, including Advanced in Korea and Aramco in Malaysia, demonstrate the view to move globally for opportunities and competition from other overseas opportunities. Inherent disadvantages like high capex, distance from market, correlated with a general lack of domestic market scale, lack of trade integration, and the commodity nature of the portfolio neutralizes some of the advantages of the benefits from advantaged feedstocks. For this reason, we expect the leverage historically provided by advantaged gas liquid feedstocks to wane. And going forward, this means strategies which rely on leveraging higher cost feedstocks to be a bigger part of the portfolio, as you can see from the graphic, where we're seeing more of an expansion of liquids from liquid-based conversion of naphtha. However, from a positive note, positive perspective, the broader-based chemical platforms and feedstocks enable strategies that could be focused more broadly and enable more value-add products. The markets also suggest growing opportunities in these areas. Today, the GCC portfolio is very commodity-oriented. In fact, commodities represent about 90% of GCC polymer production, while specialty chemicals only represent about 3% of GCC production in 2015. And while by improving we think by 2022, nearly 70% of all incremental supply growth will still come from commodity polymers. While small by absolute standards, the markets are poised for rapid growth in specialty chemicals and other value-added chemical intermediates as the economies and population in the Middle East and Africa rapidly expand. In fact, more than half of the population growth globally in the next 25 years will take place in this region. And this shift in population will demand greater resource efficiency, a need for higher crop yields, increased renewable energy, reduced emissions, higher fuel efficiency standards, in addition to basic needs by clean water. This transformation, in order to address these market opportunities, is not easy. The key success factors required in the value-add markets is substantially different than those required for commodity markets, as we'll see in a moment. So I'm going to switch gears here a little bit and now give you some perspectives on a framework that we look at when we analyze the need to shift strategies and business models in the case of what we're thinking about for the GCC. At IHS, we use this framework to describe the performance of a company. High performers excel in each of the 6 areas. And I'm going to provide a brief overview of the framework and really tend to think about it in the 3 horizontal layers. At the top, we have strategy, which provides the company's goals and overall game plans and provides the boundaries and guidelines for other components in the framework. The second layer, the business model and processes, is all about structure and differentiation. Successful companies may have strategies similar, but their business models and key processes are what typically set them apart. And at the bottom, we have the foundation of the business: resources, capabilities, and people. These components enable a firm to execute its strategies successfully. So rather than review each component, I'm just going to take a couple of example from each layer. Of course, at the top, the first component is strategy, which we define as how a company identifies and segments its customers, engages competitors, and responds to the market environment. For many in the GCC, the strategy that got you here may not be the one that will serve you best in the future, certainly not the one that's needed in terms of the overall economic transformation. Changes in market dynamics will require a shift from one of monetizing cheap raw materials and chasing netbacks to one of more of a value-added growth orientation. Making this change will not be easy. It will require more aggressive goals and an increased emphasis on market and market insights. In addition, it will require rigorous and objective reviews of existing portfolios, and such reviews may likely lead to not only the need for investment, but also potential mergers and divestitures, or even a shutdown of uncompetitive businesses and facilities. The latter is relatively uncommon to date in the GCC. The second component is a company's business model. Many in our industry recognize the importance of the right business model, but many can also not clearly state what a business model is or how to differentiate it from strategy, let alone describe what it takes for their company to make money. From our perspective, simply put, a business model describes how a company is structured and its methods for maximizing profits. At IHS, we recognize over 10 distinct business models in the chemical industry. To date, prominent business models in the GCC are focused on optimizing feedstock or concentrating in the commodity end of selected value chains. In the future, we expect to see more companies focusing on specialty products, value-add products, and even solutions that will require entities with knowledge-based business models. Sadara is an example. Advanced Petrochemicals' recent announcement about specialties investment is another. However, changing one's business model is not a trivial matter. It must be aligned with the business strategy and include a clearly defined value proposition and value capture mechanism, as well as the key resources, processes, and capabilities to deliver both. Finally, one does not select a business model and keep it forever. Times change, markets change, and so must business models. Industry leaders continue to reinforce, refine, and even redesign their business models as necessary. The final area I'll address is capabilities. Capabilities are those things that you do or own that are highly valued by customers and clearly differentiable from those of our competitors. For example, things you do include product and service innovation, customer service culture, and ability to attract and retain top talent. Things you own include tangible and intangible assets that provide competitive advantage. This includes low-cost facilities, proprietary technology, brands, etc. Examples from some high-performing chemical companies include Ecolab's approach to products and services, BASF's Verbund concept, and SABIC's ability to form successful ventures. I guess for those in leadership in the audience, we would challenge you to think about and define 2 to 3 capabilities that you need to successfully execute your strategy that have a market impact and cannot be easily replicated by your competitors. And while you're at it, see if you can identify those potential fatal flaws. That is, those capabilities you do not have but need to have in order to be successful. So in conclusion, a number of points. From our viewpoint in our economics sector, GCC continues to face economic headwinds. We think there is opportunity in the near term with oil's price rebound to be able to help diversify the economy to meet expansion challenges. And truly, the chemical industry is a key enabler and part of the solution for economic growth. Commodity chemical investment for resource monetization is unlikely to meet those challenges. And GCC chemical producers have an opportunity to refocus, retool business models and strategies. But those new frameworks will require companies and policies to adjust in order to improve agility and capability and change the framework away from simply feedstock monetization. I look forward to your questions in the panel session. Thank you very much for your attention.